With the chaos in the Middle East these last couple weeks, along with Russia, Ukraine, China and Taiwan, the trade wars, one would think that the markets would be in free fall. But that is not the case. The markets are within 0.5% of new all-time highs. Why is that? We'll explain today. Let's get into it. So my name is Will Allen with Sentara Capital. We are a long-time RIA. I've been in the business 27 years. We love doing these market update videos, and there's been a lot happening late for us to tackle today. And we're going to start off with the conflict in the Middle East. It was about 2 weeks ago, and we're filming this on Tuesday, June 24th. It was about 2 weeks ago when Israel bombed Iran, and that happened on a Thursday night, came in on Friday morning. The markets were down about 1%, and we did a YouTube short, also posted it on our new Instagram page. So if you want to subscribe or follow both those pages, you'll benefit because we posted a little video where we talked about the fact that geopolitical conflicts, while they're typically scary and concerning, they often don't have a significant impact on the stock market. And our strategy is, if there was a sell-off of significance, we want to buy. Well, that didn't happen. In fact, by the end of the day, the markets had recovered almost that whole 1% decline. The last 2 weeks, it's been going up to where right now, and you can see the chart of the S&P 500 there, we are just about 0.5% shy of an all-time high. And we've talked for the last couple months following the big sell-off in early April about the reasons for the rally, and you can go back and watch some of them. But now that we're knocking on all-time highs doorsteps, we think it's important to understand this. Back in December, the markets also were at an all-time high, and we did a video where we talked about concern we had that there was euphoria in the marketplace and that a sell-off could come out of nowhere. And that literally happened the next day. Well, as we stand now, we do not see that being the case. In fact, we're putting up a chart here from Bank of America. This is a global fund manager survey, and it looks at investment managers. And in blue on the top, on the far right, are if the fund managers are overweight. So the Eurozone, stocks in Europe, they're very overweight those, then emerging markets, then banks, then the European currency. You get the picture. Now, as you come down on the left in red, that means the fund managers are underweight. They have less exposure in some of these other areas. And at the very bottom is U.S. stocks to the tune of 35% underweight there. The dollar is second next to that. But here's the point, is we love to see this because what concerns us is when everyone's on one side of the boat, when fund managers, when retail investors are all in on U.S. stocks, that's a concern. Well, as you can see here, and this is from about 2 weeks ago, that is not the case right now. And the same is true if we look at the investor sentiment surveys. Investors are not super bullish like they were in mid-December. So we are glad to see that. Let's now get into what could happen next in the markets. So one of the topics the market is closely watching has to do with the Federal Reserve and interest rates. What are they going to do as the year goes on? To recap, the Fed had raised rates aggressively in 21, 22, early 23 to head off inflation after they were caught on the wrong side of that. We've talked about that a lot in the past. And then they held rates up at 5.5%, the Fed funds rate, for a long time until last fall. And they cut interest rates 3 separate times. Here is a chart that shows the path that I just discussed. And you can see that right now the Fed has a range of 2.25 to 2.5% on the upper end of the range. That's an effective rate of 4.33%. Now, there is some controversy around should the Fed have been cutting interest rates. We talked in our last video about the inflation picture and how inflation has been coming in cooler than expected. And in fact, the Fed's favorite measure of inflation is very close to their 2% target. So the question is, with inflation doing better than expected, why has the Fed not cut yet? And the answer is Fed Chair Powell has been waiting to see, are we going to see a lot of inflation from tariffs? We talked about earlier in this year that in 2018 and 19, during the first big trade war during Trump's first term, there wasn't inflation as a result of all those tariffs. And so far this time, that has been the case again. Now, it doesn't mean we're not going to see any, time still to tell. But we want to go over some new information with you that really points to the fact that Powell probably should be cutting interest rates. What you're looking at is something that takes the CPI, the Consumer Price Index, a measure of consumer inflation that last month came in at 2.4%. There is in this measure, housing plays a big role, and they use something called owner's equivalent rent, which is where they ask homeowners, how much would you pay to rent your own house from yourself? So it's a made up measure. There's nothing real about it, okay? It is showing inflation in housing of 4% year over year. We'll take a look. If we look with the last 2 months, we have had housing prices nationally drop month over month. And you can see right here, the last 2 months, housing prices have gone down. That is good news because we did a housing video last month that was very popular. We talked about the fact home prices are too high when you consider how high mortgage rates are, and that's making it very tough in the housing market. Well, the other piece that comes into play here is how much it costs to rent an apartment. And we have data on that for you also. This first one is a year over year, takes a look at a service called Apartment List, and you can see that has been in the negative territory year over year now for 2 years, since the summer of 2023, meaning if you wanted to go rent an apartment, you would pay less in rent than if you had come the previous year. That is very good news right there. The second thing we have for you is this is a new tenant rent index. So this is saying, hey, if you are a brand new tenant and you walk up and you can see there, look at that. That has been in a precipitous fall since its peak in late 2021 up at near 12 or 13%. That is now down 2.2% year over year. So you want to go sign a brand new lease, this is a good time to do so. So when you take both of those into consideration, the fact that home prices have dropped a little bit recently and apartment rents are down, and you put them in place of owner's equivalent rent, you get an inflation rate not of 2.4%, but of 1.55%. That's below the Fed's mandate or their target. So the point is, you can make a case that the Fed probably should have already cut interest rates once or twice over the last couple months. Now, we've said, and we don't get political, but the president has obliterated Powell in the media, and it does not make any sense because he's really hurting himself. He's put Powell in a place where Powell doesn't want to cut and look like he's capitulating there. But the bottom line is, if you actually look at the data like we just showed you, the case should be made that the Fed probably should be cutting, and we think they will as we get a little later in the year. Now, if you've liked some of the info we've gone over today so far, make sure to like and subscribe. We appreciate it. All right, in just a minute, I'm going to talk about a chart that is going to blow your minds because it is the opposite of what you've been told. Stay tuned for that. But first, we're talking about the dollar because it's been in the news over the last month and a half because it has been declining in value. So we thought we would put that move in context. This is a 10-year chart of the dollar. You'll see it's at 98.28 now, and this is the dollar versus an index that includes the euro and the Japanese yen and a few other currencies. And yes, it has been declining over the last couple of months. There's no doubt about that. And there's some good and there's some bad. I'm not going to get in the weeds of that now, but it's not all negative where you see that going down. But here's my main point that I want to make. Number one is where it is today is kind of the middle of the range it's been the last 10 years. So it's not like it's much weaker than it's been in decades. Number two is we're putting up another chart of the basically positioning, investor positioning. Right now, everyone is betting against the dollar, okay? Everybody's crowded on one side of the boat thinking the dollar is going to keep going lower. And in fact, if you look in the last 11, 12 years, the only other time that everybody's been betting against the dollar this much was in early 2018. Now, let's throw a chart of the dollar back up that we were just looking at, because look at early 2018. The dollar hit a low of 88.6, and look what happened. Almost immediately, the dollar appreciated in a big way and had a run for basically about 2 years there. So here's the point is, even though the dollar has been weakening over these last couple months, now everybody's in that trade, and oftentimes that means we get a strong rally the other way without warning. It would not surprise us if that happens. Now, here's the chart that I just told you about a minute ago that's going to shock you. And let me set this up. When the tariff wars really broke out in early April, one of the things, and remember at that time, the stock market was in free fall, Bitcoin was in free fall, it was a rough time. And also the narrative was, hey, because of all the tariff uncertainty, all these countries overseas were selling their U.S. Treasury bonds because they wanted to get their money out of the U.S. That was the narrative. We heard that quite a bit. Well, every month we get updated holdings of our Treasury bonds by basically foreign investors. Take a look at this, and this chart goes back to, I think, 2000. This just hit a new all-time high of $9 trillion, meaning investors not only overseas are not selling U.S. Treasuries and taking the money and running, they're putting more money in and buying more U.S. Treasury bonds. And again, this is the opposite of what's been reported in the financial media and just the traditional media over these last couple months. I was shocked myself when I pulled up this chart. Now, one last thing on this note. When I was talking with my buddy and partner here, Evan, and I said to him, hey, what country, if you could name one, to say, oh, we know for sure there's one country where they've been selling our bonds, and he said, Canada. Surely Canada's been selling. Well, take a look at this chart. Even Canada has been buying our U.S. government bonds. In fact, last month bought the most they've done in 1 month going back to 2023. So listen, the reason I do these videos, I like to have charts that's really helpful for our clients and any other viewers, and is a different opinion than what you're hearing in the media. And this is a great example of it, but it's important to note that foreign investors still want U.S. Treasury bonds. All right, now for rapid fire, where I go over a couple other charts that I think you need to know about. And the first one is taking a look at capital spending by the U.S. tech giants. And what this is looking at is over the last 4 quarters, and you see the list there. We got Amazon, Microsoft, Alphabet, which is Google, Meta, which is Facebook, Oracle, and Apple. We start off at the top. Amazon has spent almost $95 billion. And yes, you heard that right, $95 billion over the last 4 quarters. Microsoft's not too far behind, over $80 billion. Alphabet right there just shy of 60 billion. Now at the very bottom there, you'll notice that Apple is really lagging. And by the way, Apple stock has not done well. All these other stocks have done well, not Apple. And this is one of the reasons people are upset, because they're lagging behind the AI race. But hey, here's why this matters is when they're spending money, that's other companies' revenues and profits. These companies all believe AI is changing their businesses in a good way and is going to be very good for revenue and profits down the road. Some of them are realizing that even now, but they're spending a lot of money. And we've talked about the last two earnings season, mid-January to mid-February and mid-April to mid-May. The markets did very well because earnings season came in much, much stronger than analysts were saying. And in the long run, corporate profits are what drive markets. Well, this is one of the things that says, hey, the AI theme is very real, and all these companies believe they've got to spin big to be competitive in that space. This is a good thing. All right, the next chart is taking a look at oil prices, and this is where, and this is the last two charts on this, and I'm done here, ties together with how I started off talking about the conflict in the Middle East. Because when this conflict broke out, there were lots of stories about how oil and gasoline prices were going to skyrocket. And you could see the oil prices did go up. They were at 58.59 were the low, and you can see that was basically about a 5-year low when oil prices were there. And they did jump a lot to about $75, stayed there for about the time you could drink a cup of coffee. And then they, in 2 days, have plummeted with the ceasefire that is taking place, have plummeted down to $65 a barrel. You can see outside of about a month, this is the lowest level in basically 5 years that oil prices have been. One of the reasons the oil prices did not go higher is because of our last chart here. This is taking a look at U.S. net imports of petroleum and refined products, so gasoline and oil, etc. And you can see some of the past conflicts. The U.S. had to import a lot of oil, and so prices went up a lot when there was conflict. Well, this time we are a net exporter, which means we sell more oil than what we import. We're energy independent, basically. So because of this, prices didn't go up near as much because we have our own oil here. So that answers a big question of why did oil prices not go higher? We thought you would like to know that. So the main takeaway today is the stock market is near all-time highs, despite the fact we've had a major geopolitical conflict, in fact, a couple over these last few weeks. And like we said in the YouTube short just recently, when geopolitical conflicts happen, remember that oftentimes they are very scary, but they typically don't have a significant impact on most companies in the market, so they don't stay down for long. Hey, if you are new to Sentara Capital, go to our website. You can go to the contact page and reach out. We have a 3-meeting process to see if we are a good fit. Thanks for watching and take care.